S&P Global, 15th of February 2024, Iraq expects Chinese investors to assist in achieving its ambitious output development objectives. Desperate nations seek alternative security partners as the United States, now self-sufficient in oil, ceases to require the Middle East and embarks on its voyage away from the region as its primary protector. Baghdad is progressively shifting its focus towards alternative investment destinations in the East in response to the reevaluation of portfolios by major Western investors pursuing greater returns and Iraq's long-standing and ambitious objective of increasing its petroleum production capacity. Chinese entities oversee approximately two-thirds of current production and 34% of proven reserves in Iraq. The largest Chinese investor in Iraq, CNPC, owns West Qurna, Ahdab, and Halfaya properties. Minor entities, including CNOOC, Union, and ZenHua, are also engaged in production activities within Iraq. A collective of Chinese corporations holds direct interests in an estimated 24 billion barrels of reserves and is accountable for an estimated 3.0 million barrels per day of production. Additional Asian investors, such as Pertamina of Indonesia, Ichigo, and JPEX of Japan, have also invested in Iraqi initiatives. However, expansion strategies are impeded by domestic concerns such as restricted water resources and export capabilities. Disputes regarding production control in the semi-autonomous Kurdistan region have significantly reduced Iraq's petroleum output. Iraq is also bound by an OPEC+ quota of 4 million BD, however, according to the most recent Platts survey of the alliance's output, its recent output has been significantly higher at 4.27 million BD in January. The Iraqi Oil Ministry announced on February 14 that, over the next 4 months, it will assess output and make adjustments for any increases. Iraq, the second-largest hydrocarbon producer in OPEC, aims to increase its capacity from approximately 5.4 million BD in mid-2023 to 7 million BD by 2027. Increasing production is feasible from a geological standpoint. Still, according to Sarah Haggis, Chief of Middle East Technical Research at S&P Global Commodity Insights, export capacity constraints will make it more challenging to do so practically. Export difficulties, an antiquated and deteriorating infrastructure and a political and financial dispute with Turkey that prevents exports from northern Iraq via the Turkish port of Ceyhan restrict Iraq's export capacity. As of March 2023, the Kirkuk-Ceyhan pipeline was decommissioned. On average, Ceyhan exported approximately 75,000 BD of Kirkuk grade and 375,000 BD of Kurdish blend test. As a reaction, Iraq has augmented production in alternative sectors to offset the decline in output observed in the north. According to S&P Global, the majority of production could recover rapidly if the Ceyhan pipeline dispute is resolved. Despite sporadic reports of negotiations, minimal advancements have been achieved. Xuan Zulal, managing director of Carducci Consulting, told S&P Global that oil exports from Kurdish oil fields are unlikely to resume shortly unless the parties involved compromise their positions. As of now, no substantial movement has been observed from any of the involved parties. International oil companies, IOCs, in the Kurdistan region have reduced expenses while continuing to sell discounted crude oil to the local market in exchange for advanced payments that cover their operational costs. As a result, a portion of the output has already resumed, as businesses have located local purchasers. DNO, a Norwegian oil and natural gas operator, reported on February 8 that the aggregate output from its TOC license in Kurdistan had substantially returned to pre-exportation levels to Ceyhan. A contentious ownership dispute regarding gas and hydrocarbons produced in Kurdistan remains a significant concern. The Federal Supreme Court of Iraq ruled in 2022 that the KRG lacks the jurisdiction to market its crude and natural gas independently. The ambiguity surrounding control is undermining investors' confidence. Investing difficulties. Iraq's production objectives necessitate continuous foreign investment, including in the Basra province, a major oil producer. The region, encompassing significant fields such as Rumaila, West Qurna, Zubair, Majnoon, and West Qurna Phase 2, attracts foreign investment from Chinese and Western corporations. The potential consequences of alterations in the composition of shareholders on Iraq's capacity to increase production are considerable, as there are frequent speculations regarding intended withdrawals. Typically, these corporations renegotiate terms and opt to remain, but ExxonMobil recently ceased operations in Iraq by divesting its 22.7% ownership interest in West Qurna to the Iraqi Bahriya Council. PetroChina is assuming the role of project operator. Before this, in 2021, ExxonMobil sold a 32% interest in the Bishkek license in Kurdistan. This occurred after Shell withdrew from the Majnoon field in 2018. At the moment, BP is the operator of the Rumaila oil field, while Eni is in charge of Zubair. The Iraqi energy sector has become more under Chinese control due to Western divestment. Their participation in Iraq has thus far been met with acclaim, as companies have complied with local regulations and project operations have operated smoothly. Additionally, China is the largest purchaser of Iraqi petroleum. China receives an average of 1.18 million barrels daily, or 35%, of Iraqi crude exports. It ranked third among the largest suppliers to China in 2023, trailing only Saudi Arabia and Russia. At present, the energy activities of Russian corporations in Iraq, such as Gazprom's investment in Basra, Rosneft's activities in Kurdistan, Lukoil's stake in West Qurna II, and the recently identified field of Erido, remain unaffected by Russia's invasion of Ukraine. An indication of Iraq's dedication to collaboration with Russian enterprises, Lukoil recently reached a mutually beneficial agreement with Basra Oil Company, an Iraqi state-owned enterprise, to double oil production from the West Qurna II asset to 800,000 BD and extend the oil service contract for the purchase by 10 years, to 2045. Iraq has the potential to enhance its appeal as an investment destination by increasing water accessibility. Total Energies is constructing a seawater purification facility to supply injection water for oil field pressure maintenance. This is an alternative to rivers and aquifers, which provide unreliable freshwater supplies. Analysts perceive minimal impact on output schedules when departing companies divest their stakes in other seasoned foreign firms. However, potential disruptions may arise if the entities fall under the control of the Iraqi government. Iraq is energy dependent to a significant degree. In the coming years, it will continue relying on high oil prices and foreign investment to support output and the state budget. The fiscal break-even price for oil, as estimated by S&P Global, is $101/B in 2023, $97/B in 2024, and $103/B in 2025. This is far higher than the going rates, which are being pushed lower by growing non-OPEC supplies and worries about the state of the world economy. On February 14, Platts, a division of S&P Global, valued Iraq's principal crude grade, Basra Heavy, at $77.97/B,